Okay. Hello. Is this working?
All right.
Hi, everyone. Thanks for joining us. This is the Market Outlook panel where we're going to talk about growth trends and investment strategies within the cybersecurity sphere. I'm Annie Massa. I'm a journalist with Bloomberg News covering market structure. We have three great panelists who I will let introduce themselves. Do you guys just want to give a brief intro and what your day-to-day coverage sort of area is?
Thank you, everybody. Glad to be back for the second year in a row. My name is Shaul Eyal. I work for Oppenheimer Company. It's an investment bank focusing on technology, on consumer, and on healthcare greatly. I've been covering cybersecurity for the past probably 17, 18 years. Back at the times where cybersecurity was observed more as the stepchild of the broader networking arena, I think that trend, without a doubt, has changed over the course of the past few years. I cover almost every other publicly traded company out there. There are about 15 traded cybersecurity companies, as well as some additional big data and analytics names. Very excited to be here. A lot to share and discuss with you. A great platform. I think just the fact that really before Andrew gets the final number for the year, having been here last year, looks as if number of participants, without a doubt, has doubled. I think also suggesting that there's a lot to discuss. A lot is happening within this arena. Glad to be here.
Great.
Thanks, Shaul. Eric McAlpine. I'm the founder and managing partner of Momentum Partners. We are the first cybersecurity exclusively focused investment bank. I founded the firm about 3 years ago. My background is traditional investment banking. Before founding the firm, I spent a 6-year stint, founded Blackstone's Silicon Valley Advisory Office. Blackstone obviously has a big, prominent presence in cybersecurity, and I started that practice back in 2008. Prior to that, I started my career on Wall Street here in New York, actually, and then moved to San Francisco in 2002 with the Salomon Brothers training program. And picked up a few accounts as an associate. Was just talking to Shaul back then. Cybersecurity was not cyber anything. It was security or infosec, and it was definitely the stepchild within the enterprise software group, and handed to a junior associate with no career path. But 17 years later, I founded a firm exclusively focused on this space. So stick to them, I guess. Most of our work and what I do on a day-to-day basis is quite simple. We spend 16 hours a day advising founders, CEOs, and boards on matters of strategic importance, and that's how I get paid.
Great, thanks. And
I'm James O'Shea. I'm the consumer of tech in this group. I'm an infrastructure guy. For the last 20 or so years, I've been in various security, engineering, and infrastructure-related roles, starting at Smith Barney, then a little bit of time on the buy side, and recently at RBC. My views are all my own. My errors are all my own. I do not speak for RBC in any way. Along the way, I remember when security was the person in the boiler room, typically the guy in the boiler room, who people needed to have. And I ended up going to business school as an attempt to sort of file down the rough security edges on me so that it was more of a general technology manager. I feel like the guy that sold Apple at 10. Having done that, and now finding that the business relevance of cyber is front and center, and that, I think, is the most exciting part of it. Prior to coming back to New York, I did intelligence analysis for a Navy lab. So the intersection of national security policy, business, and technology is where I think the most interesting space is for me personally at this time.
Great, thanks guys for joining us. So I wanted to start, we touched on it a little bit in the intros, but in your careers in cybersecurity, how do you feel like the industry has changed, and how can that inform how we look towards its future? Sure, we can start with Eric next time.
There's more public companies. The market cap is greater. I think the TAM obviously is much larger now. Cybersecurity was mentioned, I think, 17 times in the presidential debates. That had never happened before. It certainly is part of the news cycle. We just experienced it last week. There's an ETF. These are all things that are important to me in terms of capital markets flow. Last year, $4.3 billion over 225 companies was put into the sector. It was quite the party. Before that, I called the peak a year too early. It was 3.8 billion into about 250 companies. We track only if, companies that raise $1 million or more. So if your dad gives you $100,000, I wouldn't know about it. But if you look at the velocity of exits, which we participate in and advise upon, it's nowhere near catching up. We've got about a 13.5-year backlog in terms of IPOs and aggregate M&A volume to catch up to the amount of money that's invested into the sector. And now what we're seeing is a very discerning investor. I know many of you out there, your standards have definitely elevated in terms of what I should bring to the table and my clients. And so I think that has changed considerably recently.
Yeah, definitely.
I would add and build on top of that. This is an industry, and from our perspective as research analysts, we like when, on the one hand, governments are getting involved from a compliance, from a regulation angle and perspective, because that always usually accelerates a longer-term spending cycle. That's on the one hand. And I think the fact that probably from an industry perspective, this is one of the categories, more of a mission-critical category of the broader IT arena, which actually has been seeing a year-over-year acceleration over the course of the past few years. So, the IDCs and the Gartner and some of the other industry firms, every year comes out with their predictions. And actually, when you go and look back in hindsight, over the course of the past 3 years, actually, this is a category that has been seeing nice acceleration. Again, those are big numbers to shift. So just a shift from a 10% year over year to an 11% year over year type of growth, when we're talking about a double-digit billion industry, these are significant numbers to think about. Also, to add on Eric's perspective, with respect to stepchild being into an industry of its own, with that view in mind, we still think that there is a little bit of an imbalance of supply and demand, again, mostly from a publicly traded perspective. What do we mean by that? We have about 15, 16 publicly traded companies. From a market capitalization perspective, we have only 3 large caps: Checkpoint, Symantec, Palo Alto, and then a big list or a large list of mid-cap and small-cap names. Part of the reason that we're seeing this imbalance of supply and demand, supply, obviously the public market or private markets going into the public markets, but demand from investors to trade more, this theme. Part of the fact that we have this imbalance has to do with the consolidation this market has been going through over the course of the past few years. And Eric, just before we started, asking me, so on the one hand, who do you think could be making it over the course of the next 12, 18 months into the public market? On the flip side, who could be potentially bought out by some of the bigger networking companies? So just to keep that in mind as well.
Sure.
And I think to the point about this becoming an industry, earlier this week, the Journal ran a story with the headline, now all IT jobs are cybersecurity jobs. And I'd actually drop IT from that headline to capture the pervasiveness to which we're going to see this expand. That cyber no longer becomes the IT department's problem. I think we've had recognition of that. And I think the connection of risk in terms of something bad that can happen to me is becoming more and more prevalent from the bottom of the technology stack up to the overlying business process. And that, I think, is an area that I don't see that much coming if I'm consuming technology. When something goes wrong, when there's a worm or a malware outbreak or an outage worldwide, someone who's a revenue generator is not interested that server number 25 doesn't have patch number 16. They're interested in, is this business process, is cash equities impacted? Do I have to, if I'm a medical provider like the National Health Service, do I have to fall back to paper records? How do I do prescriptions? And I think understanding where those processes need reinforcement is a space that's sort of probably more service-based than product-based going forward, as people grow the maturity and realize that this is something that they need to consider, and the guy in the boiler room is not going to take care of it for them.
Sure, so in a sense it becomes everyone's problem. Keying off of when things go wrong, I wanted to talk a little bit about Wannacry and the implications on spending that you might see because of it. Is there anyone who wins out in a scenario like that? Who are the winners? And can we quantify who's profiting from that ransomware attack?
Sure. Should I go? Yeah. So I think Wannacry, from our perspective, back about 10 days ago, for us, and I know maybe I'm being a little politically incorrect about it, it was like a Christmas present, meaning to say that back on Monday, right after the news broke, almost every other company in our space, in the security space, was trading up anywhere between 3% up to 10%, that same day on Monday. Now, the way we look at Wannacry and the potential implications down the road, we always like to go back, look for some sort of an analogy point, and try and make some reference. Let me take you back to late fiscal 13, the very famous Target attack, TGT, that's the ticker. That was actually the first time in global corporate history, US history, whereby a CEO paid with his seats was pretty much ousted by the board, fired by the board, for lack of security measures. I think what we've seen after that is pretty much starting 6 months following the attack. So if we start thinking about it, second half of 14, first half of 15, we had seen an elevated spending cycle. Some might view it as more of a panic buying mode, meaning to say some of those enterprises just buying everything because they have their board of directors breathing it on their neck. Make sure the name of our company doesn't make it to the front page of the Wall Street Journal, Financial Times, New York Times, what have you. So if we're in a way interpreting that going forward, we think that the potential tide that could be coming down the road within the next 3 to 6 months, again, could be elevating the entire group as a whole. And there's going to be a period of moderation right after that, as we have seen in the second half of 15, if I'm taking you back to the Target period. So from our perspective, almost everybody benefits from that, near midterm. And again, later on, there's going to be some periods of choppiness.
I think that one of the challenges in terms of who benefits is that, to your point, that someone can write purchase order after purchase order after purchase order before or after an event. And it's difficult right now. I don't think there's a good rule of thumb that consumers of technology have and bearers of risk have as to what the right amount is to be spending on cyber or how I should be thinking about it. There is not, to my mind, the sort of property casualty or health insurance or occupational safety insurance type market where there are pricing indicators available to let you know that it's going to cost me X as a premium to cover Y amount of risk. And that in part is, I think, because, again, that connection to what the business risk is. Target, as an example, and I think there was a study probably a year or so ago about companies that have experienced large public events, sure, haven't really seen it reflected over the long term in the valuation of the victim company, in part because maybe there's a healthy shift to the fact that they are victims, that they're trying, and that companies want to do the right thing by their investors. And probably another part may be that it's difficult to price risk and things like this about the future where there's not a lot of experience. So I think there is a fear factor and that drives a lot of sales, but does that normalize, right? We see large variance in spending amplitude, and does that just sort of tamp down over time? I'm not really sure without some sort of pricing mechanism to show you that your spend is right. Is it supposed to be a tenth of my IT budget? Is it supposed to be 2% of gross revenue? I don't think anybody has a handle on that.
And should it differ by industry, or if you're a retail company or not?
Well, and to that respect, if you look at industries, you may look at regulatory thresholds as an indicator, not so much of the appropriateness of the level of spend, but the activities that you're doing that are best practice. The New York State guidelines are probably the most specific example. The federal NIST cybersecurity framework is a more general way of looking at the problem. I think where you try to intersect those two is, do you have a formal way of looking at the problem? And then are you meeting certain industry-specific guidelines. And this is where I think collaboration across industry sectors and within industries is going to become important.
Sure. Yeah. Eric, what about you?
My periscope is kind of pointed in a very particular direction. Maybe I'll give kind of the investor view of as we're kind of almost about mid-year. Right? Mm-hmm. It's a good time to kind of check in with those portfolio companies and gauge realized performance versus projected performance. And with Wannacry, I was on site yesterday in Phoenix at a client SOC, and the CFO happened to be there, and we pulled her aside and asked kind of what the implications were from the marketing department, because the phones were starting to ring a little bit more and that website was getting a little bit more action. This is a service provider company. And so we sat down and we just looked at kind of Q3 and Q4, and probably about 4 or 5 more deals per quarter we're going to get pulled in per quarter. So at least from a rubber meets the road, your sales force, pretty sure that they're getting their calls taken a little bit more today than they were maybe 2 or 3 weeks ago. Sure. And purchasing behavior is changing, again, to the benefit of sales achievement.
Right, as long as it's top of mind.
And then I'll add one more, which maybe it goes back to your prior question, which is what has changed today that you didn't see maybe 2 or 3 years ago. And we were talking about this, which is companies that have no business in cybersecurity, no digital business whatsoever, are now starting to ask the question about what's our cybersecurity strategy, corporate strategy, not their strategy with their CISO that has to answer to the board, but should they be in a growth market? Honeywell, General Electric, ADT, Verint, these companies that have access to our homes and to our businesses and protect us in a physical manner are starting to wonder if that is the gatekeeper to also protect our digital networks. And so I think what you're going to see from our firm is a series of announcements of deal activity where the logos on the tombstones are not the 15 companies that you cover or even the companies that surround them, but are going to be companies that are covered by some of your colleagues.
Sure. Sure. And so what do you 3 see driving demand more generally in cybersecurity investing? Is it only a big event like Wannacry or a big attack or a breach? Or are there other factors that we should consider when we think about what drives demand?
Fundamentals. I think everybody in here is probably fundamentally driven and not driven. Didn't sign up for this conference because of Wannacry. Mm-hmm. It really is fundamentally driven. Our firm subscribes to what we call the rule of 40. I came up with this bubble chart at Salomon Brothers, and it was the thing that I would tout around to every client. And essentially what it was the bubble was the size of the market cap. And so a lot of them were little, and only 3 of them were big. Yeah. And then did a regression analysis for forward revenue growth. This is how simplistic this was, to enterprise value to revenue multiple. And for 10 years of my career, this thing regressed out between 60 and 80%. And I thought I was a genius because the line made sense to me. If you track the regression of forward revenue growth to your revenue multiple over the last 6 quarters, it's gone completely out of, it's a straight line this way, right? It's out of regression. It's about 8% now, 12%. But if you do the following, if you actually look at back to basics and fundamentals of running a business, which is for profitability, if you add the quantum of revenue growth to EBIT margin, so your operating profit, and you run that regression against your value, that regression snaps into like about 55%. And so all of the very sophisticated large private equity funds, Vista, KKR, Blackstone, obviously they're financially driven, and to make their models work, there has to be some measure of profitability most of the time. But they look at it on a balanced equation. If you look at the public markets, your clients now, I think that's snapped back into it.
Absolutely.
I think that's what drives most investing today.
Sure.
Yeah. I'll touch maybe a little bit just from a fundamental drivers. We touched a little bit in the prior question. So from our perspective, in a way, what's driving the CTOs and CFOs and CEOs to procure more security solutions? It's number one, regulation and compliance, not by the, not necessarily by disorder. The second thing, probably over the course of the past 5 to 10 years, we had seen also a shift from a network perspective, architecture perspective. So without a doubt, the cloud has been impacting the way or the new way that some management teams are looking on their security spend. Networks have become much more complex. Some 10 years ago, there was more of this fortress approach and dynamic in a way we work within our enterprise or our network enterprise. Nowadays, the whole play on endpoint and remote access. So that in a way represents a new paradigm. And that new paradigm obviously is becoming quickly a new driver for security spending. So network sophistication, network architecture, compliance and regulation, and also how those attacks have become complex over the course of the past few years. So it's not just a worm that somebody, like an 18-year-old kid might have sent you 10, 15 years ago, and the antivirus will quickly take care of that. We actually have, state-sponsored teams of hackers that are also launching those big attacks. So that also just another, call it secondary or primary driver for spending perspective.
Sure. Any other drivers?
I think one of the challenges is certainly the Wannacry, as just a contemporary example, is driving the retirement of technical debt, because no one has to accrue for technical debt on their balance sheet. No IT department tracks it in their budget. And now it's not just this balloon payment that's coming due for retiring the platforms that I never wanted to invest in maintaining. In the digital world, it seems that we have yet to come to a place where we think of digital assets in the same way that a publisher thinks about their printing press asset, the mechanical plant of the firm, the capital investment. If I were a motor company, I'm going to shut down the line every year and I'm going to retool for the next year to give, there's downtime during the week for maintenance of the machines. There's a little bit of that in the digital world, but it's sort of maintenance in place, it's not evolution. So I think that there are companies that have demand for services and products at the bottom of the maturity stack. Can you tell me what you have, where it is, how critical is it to you, and if your building caught fire, what are the top 10 things you'd grab to run out the door and be sure you could reconstitute your business the next day? That's not the fire department's job. That's business's job. And if they've starved their technology folks of the resources historically, or just not focused on them, to say, this is my inventory, this is where the service and the process runs, this is the criticality associated with it, I'm going to take the time to conduct an exercise where I fail these systems and demonstrate that I can recover them. All the way up to the much more sophisticated users, the very large search engines who are now shrinking the perimeter down to the point where the cliche is now identity is the new perimeter. So those more sophisticated people rely on finer-grained software development tools to instrument their environments. But I think there are a lot of people out there who don't have a good inventory.
Sure, sure. Is the story different by geographical region? And are there considerations in terms of cybersecurity and investing in this sector based on where in the world you are or what geography you're entering?
I think the most obvious one is the GDPR. Mm-hmm. So if you're operating in a jurisdiction or in an industry that has very strict regulation, that's going to make retiring your technical debt or continuing to invest in your capabilities a non-discretionary spend. And I think that's certainly a clear one.
That makes sense.
Yeah. Indeed. I think at least from our perspective, what we had seen over the course of the past few quarters now, actually, and we're still kind of looking into exactly what's happening. Actually, we had seen a little bit of a pickup coming from APAC, Asia-Pacific countries. Some of it has to do with a period of underinvestment in critical infrastructures. So governments, in a way, waking up at times a little too late. A little bit of regulation, especially in the banking, the financial, and healthcare arenas taking place in some of those countries. So APAC, without a doubt, and you can see that in some of the reporting results. Almost every other company under our coverage experienced some solid reporting results over the course of the past few quarters, specifically within the APAC arena. APAC, by the way, represents about 15 to 20%, not more than that, from the majority of our companies' conclusive revenues. So yeah, it's probably one area which is seeing a little bit of a pickup. Europe, absolutely a lot of regulation on the endpoint front. There's also a little bit on the financial front, MiFID, from those of you who might be familiar with that topic. So it could also create a little bit of a spending bump taking place in Europe down the road over the course of the next 18 to 24 months. US, at least from our perspective, solid as a rock, as we had seen. A little bit more mature, but some new categories. You mentioned identity. Without a doubt, identity is becoming what we view as the new currency from a networking perspective. We personally like it a great deal. Yeah, so some subcategories are likely to experience some decent growth in the next 2 years.
Absolutely. Eric?
From my perspective, maybe capital markets view, certainly there are disparities around the globe in terms of capital that's deployed or capital that's desired to be deployed into a certain region. What we've seen probably over the last 18 months is these new funds that have been formed to help bridge APAC or Singapore to Silicon Valley, or Washington, D.C. to Silicon Valley, or Israel to the United States, right? That old playbook is, set up a space in WeWork and put your headquarters in San Francisco, but all your entire development team is really it's a Tel Aviv company, for essentially. APAC, I think we're seeing a lot more companies at least inquired our firm as to what they should be doing in cybersecurity, and I'm talking, SoftBank, $93 billion vision fund. They're going to definitely be relevant in the space.
Yesterday, officially.
It's big time.
Yeah.
Fujitsu, these companies, right, that have corporate development efforts that are squarely pointed on this sector, and they're coming at it pretty fast and with a lot of capital. In Israel, we're going to see Cyberbit be more relevant in the US. They're trying. They've had fits and starts, but we're going to see them become more relevant here in our own jurisdiction. So I think it's going to be interesting next couple of years.
Sure. And I'm curious, when you guys think about the actual vehicles for investing in cybersecurity, what's the right way? Is it an ETF, options, and getting into individual stocks, some combination of the three? What would you say is the best actual investment vehicle? Shaul, you want to start?
Sure. Yeah. I think also touching back on this imbalance of supply and demand. I think one of the better ways, if you want to play it a little safer and have the utmost exposure, is obviously you can go with the ETF. I think there's like a single ETF out there, HACK, H-A-C-K. And again, it pretty much covers the majority of pure play security companies out there. Again, there's always the approach that you can diversify yourself. As we had said, there's large cap momentum plays within the universe. There's some mid cap, small cap. So I think actually from that perspective, there's a little bit for almost every type of investor out there. Probably as always, diversification is probably the better way to go about it from a long-term investment horizon perspective.
Sure.
I'm consciously avoiding anything that has to do with naming a company or a vehicle. I'm just a consumer of it.
I'm not a stock picker as well. As a matter of fact, I'm excluded by FINRA from trading all those stocks. But in terms of the private markets, I think what's been more interesting to me over the last couple of years is to look at companies who either have 10 million of annual recurring revenue, however you measure that, annualize the last quarter, annualize the current month. But if it's real recurring revenue that renews at 95% plus and has a path, a line of sight to $10 million, and also a line of sight to profitability, I think that's a pretty safe place to put your money in this market. if you look at the multiples, 5.5 times on average, we exit security companies to the big publicly traded entities. And if you're good, that can be 10 to 15 times. If you're average, that's 5 to 5.5 times. And if you suck, that's 2 to 3 times. But still, it's a pretty safe haven to put your money into companies like that and recognize a few folks that's their investment strategy, and I'm LPs in some of those funds.
Great. And then I've got one more question before we open it up for questions from the audience. Are there investments out there or any sort of aspects of this space that you find is more like hype than reality, that's maybe like overheated or too hyped up?
Maybe I'll start.
Yeah.
So we did a science experiment when we founded the firm. We also do our own fundamental research, and I always subscribe to the notion of the guy in the boardroom and the gal in the boardroom also needs to be the person who actually studied the problem and is a data-driven decision maker, and that didn't take other people's research and then apply it into their own slideware and then call themselves a self-subscribed genius or whatever. But if you look at the number of cybersecurity companies out there, and if you just go and you scrape all the different vendor maps, we did that a few years ago, and we came up with this thing that we call the Cyberscape. But if you blow it up on a wall, there's about 743 logos on that. But really behind that, there's a database of 2,100 companies. And what we found was that there really was no sense of validation or order, even by the folks at Gartner. If you talk to Larry or Pendergrass, folks, like really smart people, they had these mind maps that were just too untenable to deal with in the boardroom. And so we simplified that down. And as we look at every area within that cyberscape, the reality is they're all overheated. Every one of them is overheated.
Right.
But some of them are overheated more than others, and therein lies the fun. There's a lot of entropy in this space, and that's why we all love it. We were just talking about it. If you have ADD, OCD, you have all those diseases, this is the space to be in.
Yeah.
And now you can explain it to your parents, right? Because they know. So that's even more fun. Or my 17-year-old daughter. So they're all overheated, but therein lies the fun and the opportunity is to find that overheated space and that diamond in the rough.
Right.
I would say if we have to be slightly more specific in that respect over the course of the past few years, so just touching on some elements and some hype. There's always categories or subcategories are becoming slightly more overheated when you're beginning to see the acronyms such as NG such and such, next generation such and such. So in our case, next generation firewalls as an example. So we've gone through that cycle over the course of the past few years. There's beginning to be a little bit of next generation identity type of solutions. I think also right now there's also a shift from a business model perspective, meaning to say security software as a service, identity as an infrastructure, or something as a subscription. So we got to pay attention specifically to the underlying technologies that are really driving those acronyms. There's a lot of discussion about endpoint, maybe a little bit of a repositioning of the entire concept. Some might view it as next generation antivirus products. Some will call it just like endpoint. We got to be slightly more sensitive along these lines. From our perspective, there's pretty much, and I hear you completely about the 2,100 companies. You're absolutely correct about it. We try to segment that into more of under the broader cybersecurity arena, into more of a 7 to 8 different subcategories, just trying to make our lives a little easier in that regards.
I would observe that during Kevin's demo, there was a lot of technology on the stage, but the vulnerabilities exploited were almost always human. Right? It's the rush to click. It's let's be faster, let's be more mobile, let's not spend the time to type in the PIN from the SMS message, which, by the way, the example that Kevin gave of blue boxes and phone phreaking in the 80s, is now manifest again in vulnerabilities in the SS7 switching infrastructure, which allows, and I'm sure you might have seen the 60 Minutes piece in the last year, people to eavesdrop on your calls, to redirect SMS messages. So if you rely on that for second factor authentication, that's got a vulnerability now. And it comes down to it, humans eventually make the critical security decisions, whether that's to take the time to invest and re-engineer the process or to not click on the link. The Bangladesh heist was stopped by a human a few blocks from here who looked at a transfer and said, this does not seem right. The humans in the central bank had already been socially engineered. Their process had already been suborned, and they were presented with stimuli that made them think the process was working correctly. They had forged confirms coming back to them in email. And it was a human at the release point of the funds in the States that said, this doesn't make sense to me. So if I had to pick one thing that would make a difference in those human factors things, and this is I can't believe I'm gonna say it, mindfulness training. Right? That creating a pause between the stimulus and the response, and the fact that a computer science major is talking about something like this is startling to me. But that's where it comes in. Social engineering and any con and any exploit takes advantage of the fact that you have a behavior that can be stimulated and your response is automatic, whether it's eating that next potato chip in front of the TV or clicking to open the attachment. And I don't know where there's a product to patch that.
Yeah.
Got to rewire, human brains. That's
Yes.
tougher. Thank you guys so much. Are there any questions from the audience? Yeah, go ahead in the front.
Okay, my name is Eyal. Eric, I have a quick question for you. So, in the past few years, as you've seen, to watch the RSA conference, the endpoint-centric technology companies have evolved from a few to almost 1,000 plus. The market is trying to solve the problem of malware as well as vulnerabilities, but only malware, which is 85% of the problem that we deal with today. It's still the endpoint, which is, with all due respect, kind of
Agreed.
stupid. So when we are going to see investments in smart technologies other than the existing ones, because by the way, they all use two methods, emulation and virtualization to analyze malware. That's the first part. The second part, why is it that no one is going after the source, meaning the botnet, that is distributing all this malware, such as Wannacry malware? Everybody's trying to solve it at the edge rather than the source.
Yeah. We were just talking about CDNs. Companies like Akamai becoming more relevant.
Yes.
And they will. They're going to, they have a $500 million security business with aspirations of being $1 billion security business. So our conversations with companies like that are getting more interesting. Oracle is going to be relevant in security. Mark my words. They're going to be relevant in security. Especially around the notion of identity, to your point, right? Is the identity the edge? They have a identity SOC in the cloud now offering that they're about to market in a real meaningful way to get people to purchase more Oracle Cloud. Yes, look it up. So it's called the Identity SOC. It's a cloud-based offering. Your first question around the endpoint, I mean, look, cyber is not smash and grab. That's not my quote. I have a client that says that all the time, but I like it. They're in there for months, weeks, days, but there's this whole notion of detection and response companies and folks who are really smart at knitting together people, process, and technologies. And we have a report card that we give to boards, and we say, measure your people, measure your processes, and measure technologies, because everybody's just focused on these endpoint technologies and having NSS Labs measure them and saying, oh, we're good, we're great, actually. No, you're not. They're just sitting on a shelf. Measure the other two. Managed detection and response companies, which is this new kind of emerging category of managed service providers. And these are not household names. Rook, Morphic, Arctic Wolf, eCentire, Data Shield. These are not household names, but they are going to be household names. These are companies that are going to help protect the unfortunate 99,000, because the Fortune 1,000, with your help, is fairly well protected. They've got the fortress in place. It may not be perfect, but there's a lot of people running around it, looking for bad guys. But our information, and I'm worried about my personal information being compromised, not so much by Wells Fargo, although it does piss me off when they do that, but it's by One Medical. It's my healthcare provider. It's a small little, $50 million company. And it's those folks who you really want those networks being actively managed. And when something goes wrong, their security person is a Cisco guy. But if you have a managed detection and response provider that you're spending $8,000, $10,000, $12,000 a month looking at your network every 5 minutes and catching the bad guys with SLOs of like under 24 hours, then the likelihood of something going really wrong is very low.
Sure. I think we have to wrap up, so sorry guys. But thanks for listening, and thank you three for joining us.
For having us.
Thanks, Anna.